All right, welcome everyone. Good evening. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight we're going to talk about how to calculate REO rental income on a 1003. So, how to calculate rental income. We'll start in just a minute here. Give us a second to go live on all the different platforms. We appreciate everybody tuning in nice and early. We put the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in. And we'll get it started in just a moment. Hope everybody's been having a great day so far and ready to get into the training here. So it looks like we're live on all the different platforms. We'll go ahead and get started here. We'll take the chat off the screen for now, but go ahead and keep dropping comments there in the chat. You can drop any questions you have in the chat as well. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender specializing in non-QM loans. And what we do every Tuesday, Wednesday, and now Thursday evening on these shows at 7 p.m. Eastern Time is do a new loan officer training topic. Tonight, we're going to be talking about how to calculate REO income. So, I will go ahead and pass it over to Jose here, our sales manager with 28 years of experience, to take us through how to calculate rental income from real estate owned. So go ahead, Jose.
Good evening, everybody. Thank you for joining us for tonight's training. I guess I want to give a little clarification here on some of the nomenclature that we see here. REO, as it's being used here, means real estate owned. That means any real estate in this case that our borrower owns. Reason I specify that is because sometimes people tend to think that REO means bank owned properties. Well, yeah, those would be bank REOs as opposed to individual investor REOs. REO is just real estate owned. So we're going to go through the how, not we're going to touch base on doing the calculations, but we're also going to touch base on where do they go in the application. That's why we have here how to calculate REO rental income on a 1003, because that tends to be one of the confusing parts. And where do you obtain this income information? So I'm going to give you some really good pointers here. Uh, this is similar to calculating self-employed income, right? Throughout my career, there was always like one processor in some room somewhere that you gave this kind of stuff to because nobody else was really trained to calculate it. Well, at the mortgage calculator, we want to make sure that you can calculate it on your own. You don't have to wait 2 weeks to get your income calculations back because time is of the essence. So, what are some of the important points to consider prior to embarking on your rental income analysis? Well, it's very important that you know what type of loan we're dealing with, right? Are we dealing with conventional loans? Because, very important to note here, conventional loans require the borrower to have a primary housing expense to be able to use rental income from the subject property. That's a real odd little guideline there, but if you go to the Fannie Mae selling guide, you will see it. It's in one of the points there as you open up that part in the selling guide. You start reading, and it's going to tell you that in order to use rental income to help qualify from the subject property, the borrower also has to have a primary housing expense. Something else to note is, are we dealing with a full doc loan? Why is that? Because full doc loans require the borrower to provide a Schedule E for all rental income on seasoned rentals. Now, this is very important terminology for you to understand here, because a lot of properly calculating the income is just understanding a lot of these points here, the theory and how you get from point A to point B. It's not usually a straight line either. So we mentioned about requiring the borrower to provide a Schedule E for all rental income unseasoned rentals. So let's cover what is an unseasoned rental versus a seasoned rental, because you're going to hear that a couple more times in this presentation. An unseasoned rental is a property that was just purchased or just put into service after the end of the last fiscal year, and therefore not appearing on the tax returns, and requires a lease and the last 3 months documentation that the rent was received. So, for example, you have a property just got put into service February of 2024, right? Now, a couple of things that may be happening with that property is A, did you just buy it? Or B, did you just put it into service now and it was serving another purpose before, or maybe it was out of commission due to not being habitable? Those are all very important points. Why is that? Because if you have an unseasoned rental that you've owned for 5 years and you just decided now to rent it and here's the lease, you're going to have some good reason to prove to some good supporting reason why that property was not a rental previously. I mean, if it was previously occupied as your full-time residence and now you bought another property and you moved out of that property and you can prove, hey, I just moved out of that property and I moved into this property, whether it's a new property that you bought or a property that you're renting. Maybe you moved into a 5-bedroom home and you leased out your 2-bedroom townhouse. That would make sense if you were to provide all of that documentation to prove that I just put this property to work now as a rental. However, if you don't have any documentation to support why that property was just put into service now, you're probably not going to be able to get the income from that unseasoned rental, right? There has to be some type of a connection there. And what is a seasoned rental? That's easy. A seasoned rental is just the opposite of an unseasoned rental. It's a property that was already in service in the prior fiscal year, should be listed on your tax return, right? Now, that's another issue sometimes people have. They have a property for rent, it's rented, they have a lease, they have everything, but they did not put it in their tax returns. So you're not going to be able to derive any income from that property if it's a full doc loan using tax returns, because we can only go with the information that it's appearing on the tax return for your seasoned rentals, and only your properly documented unseasoned rentals can be used for additional income. Again, we're talking about the property you just put into service because it was either a primary or your mom was living in there and you have a lease, or you have something. I'm not sure about your mom living there and you have a lease, because then you would have a lease that would be on your tax return. But I mean, there has to be a real solid reason why that property was not reported on your tax return as a rental. Now, if you're doing a bank statement loan and you didn't put that property on your tax return, that's fine, because for bank statement loans, all you got to show is the lease and the receipt, for most guidelines, the receipt of at least 3 months rental payment to match the rental payment you're supposed to be receiving per the lease. And again, if it's a season rental, no issues. It was in service last year. It's still in service this year. It's in your tax returns. We can look at the tax returns and we can look at the Schedule E. Hopefully you have it all nicely documented on the Schedule E. So I can't stress this point enough. The importance of an unseasoned rental and seasoned rental, and knowing how to differentiate between the two, and knowing the importance of documenting the receipt of the rental income for your unseasoned rentals. Now, on a seasoned rental, they may still ask you to document the receipt. If, let's say, you got a tax return in 2023 and now you're in August of 2024, they may condition you for proof of receipt of the last 3 months income, rental income, just to, spot check the fact that the property is still producing. That's perfectly acceptable for an underwriter to do that. So now we talked about our points there, some of the points to consider if it's unseasoned rental, seasoned rental, if it's full doc or alt doc. So on a conventional loan, what would the first thing that we would do on a conventional loan to see what type of income we're going to need to calculate is you're going to run the loan through automated underwriting through DU or LP, whichever is the option that you're choosing. And you're going to view the findings to determine if AUS is asking for a 1 or 2 years findings. If the 1 year finding, you only need to provide 1 year tax returns. 2 year findings, you're going to need to provide 2 year tax returns. That means if you get the 2 year findings, you're going to have to average out the information on the Schedule E, right? The income. Now, what you really got to know is that if you have a declining income, you're going to have to use the lower, more recent amount. And the same with your expenses, right? If your expenses are higher now than they were in the previous year, you're going to have to use the higher expenses as well. That's just how it works with the expenses. They're always going to want you to use the higher amount of the expenses, and they're always going to want you to use the lower amount of the income if it's a declining trend. If it's not, you can average it out. So now, if it's now we remember 1 year, 2 years finding, depending what you're asked for. So if it's a seasoned rental, remember what we discussed about a seasoned rental, you're going to review the Schedule E on the tax return to input the correct figures on the Schedule E income calculator. Yes, there is a Schedule E income calculator, even though it's pretty basic calculations, and I'll show you the screen in a couple of slides. But in order to know what to input into the Schedule E income calculator, you got to be on the Schedule E of the tax return. So we're going to assume here that we got our 1 year's findings. So we're just going to deal with that. So you're going to go to your Schedule E and you're going to look for the gross rental income that was claimed by the borrower. This is where a lot of people mess up. Why? Because they grab the lease and they say, okay, the lease says $1,800 a month. So they put $1,800 a month as the gross rental income, when it really may not be $1,800 a month. It may be $1,580, because you got to look at the actual amount that was claimed as gross rental income for the year, assuming 365 days. And then you're going to divide by 12 to get the gross rental monthly income, and then put that amount in the application. Now, a couple other things that is really important to touch on that are going to be on the expenses in the Schedule E, and items which you may need to add back if it's appropriate. So interest paid to banks, right? So that's only going to appear there. The borrower had financing on the property. So interest paid to banks is always going to be added back to the Schedule E income calculator, because the assumption is that the interest that's being paid to the bank is taken into consideration in the monthly payment that we have in our schedule of liabilities. So we're not going to double charge the borrower the expense. So the interest paid to banks claimed on the tax return will be added back. Depreciation is a paper loss, so depreciation is always added back if it's claimed on the tax return on the Schedule E, it's added back on the Schedule E income calculator. Now, the next two are a little bit confusing: property tax and property insurance. Now, in the Schedule E income calculator, property tax is shown, the section for property tax is shown with a plus, meaning an added back item. The same as the insurance is shown with a plus, the added back item. So you will only put property tax and insurance to be added back if the borrower is escrowing for those amounts in his monthly mortgage payment. You will know that when you review the mortgage statement, right? The mortgage statement is going to say if there's any escrow amount. That's why we, need to ask for these documents. The monthly mortgage statement will show any escrow amounts, including taxes and including insurance. If you see the mortgage statement and you see that the borrower then is escrowing for taxes and insurance, then you will add those amounts back in the Schedule E income calculator. However, if you see that the borrower is not escrowing for taxes and insurance, you will not add those amounts back. They will remain as expenses. And then the last category is repair and other expenses. Now, there are extenuating circumstances where you could get a repair and you could add it back or omit it. That would be a large capital expenditure type expense, like the replacement of a roof, the replacement of an electrical panel, things that you don't do every day. A roof is expected to last anywhere, depending on the type of roof, 15 to 25 years. So if you're replacing that roof now, you theoretically may not have to replace it for another 15 to 25 years. So with good documentation, copy of the contract from the contractor, proof of payment, the roof inspection to show that the roof was in poor shape while it was replaced, and a processor cert from the MLO, you could probably get that roof repair or roof replacement omitted as an expense, which will really then bump up your gross income. So on an unseasoned rental, right, instead of getting the amount listed in the Schedule E, this property has not been listed on any Schedule E, right, because it's an unseasoned rental. It was put into service after the last tax return. So you're going to obtain the lease for this property, and you're going to obtain also proof of receipt of the last 3 months of rent matching the lease. And you're going to multiply the gross rent by 0.75 to obtain the net rental income. So there's a 25% expense factor taken into consideration for the unseasoned rentals. So this is very important right here for your conventional loans or for any full doc type loans. I say conventional loans here because we're talking about AUS, right? So what about non-QM loans, right? Which I was just touching on that. So if it's a full doc non-QM loan, and I'm talking about full doc using traditional methods, tax returns, pay stubs, W-2s, all that good stuff, then you follow the conventional loan guidelines that I just highlighted in the previous slide. If it's a bank statement loan, I already briefly touched on this, a Schedule E is not required because we're not going to be reviewing bank statements, and your rental properties will be treated like unseasoned rentals, right? Most of the guidelines then on these unseasoned rentals are going to require a copy of the current lease, got to have a current lease, and proof of receipt of the last 3 months rent matching the lease amount. This is critical. If your borrower is taking these payments in cash and not depositing them, or as is the case, and sometimes they'll group the cash deposits or put them all together and just make one deposit where you can't differentiate the amount, then I suggest if you're talking with any borrowers right now that you're helping them set up these loans, discuss this, make sure they're doing this so that they can be ready when the time comes to be able to properly qualify for the bank statement loan. So remember, bank statement, Schedule E not required, but you are going to need at least 3 months rent. Now, DSCR, our flagship product, that's the easiest one, right? Because a DSCR is not a DTI-based program. There is no debt to income analysis being done on a DSCR loan. DSCR loan is a debt service coverage ratio loan where we're simply going to analyze the property's gross monthly rent divided by the housing expense, and then we're looking for a certain number, preferably 1.0 or above, for our debt service coverage ratio. So in that case, again, you're just going to have whatever is the gross income, 100% of the income, and that's it. That's your income. And then you have your housing expense and do your math. So now, if it's a purchase non-QM loan, right, you don't own the property yet, so the income is going to be calculated using 100% of the 1007 value, or if there is a current tenant in place and you're getting an assignment of lease, which is an actual document then that the underwriters would require you to provide. If you're going to say, hey, my lease payment is $1,700, but my 1007 is $1,500, they may let you use that higher amount with an assignment of lease. Right? But other than that, for purchases, you're usually going to calculate the income just using 100% of the 1007, which is a market rent schedule value. Now, if it's a refinance, right, it's a little tricky. Now, I have there 100% of the lease value or 1007 if vacant for season rental. But remember, season rental, we're going to for the tax returns, right? We're season rental. We're going for tax returns. We're going to, do a little reconciliation there to see if it matches the lease. But we're going to go with the amount reported on the Schedule E, like we just spoke about, and assuming then that we're doing a full doc, right? If we're not doing a full doc, if we're doing bank statement, alt doc type loan, then we're going to go with 100% of the lease value or 1007. Again, in this case, whichever is lower, unless you can prove 3 months receipt of the higher amount on that lease again. So, a lot of little nuances here when it's an already owned property, and depending if you're going full doc or if you're going bank statement or alt doc. Now, if it's asset depletion is your income type, then none of this is applicable for your asset depletion loan, because in your asset depletion loan, income is going to be determined by the assets of the individual, right? Liquid assets according to whatever formula of the guidelines that we're using. And if it's a profit and loss loan, again, it's not, the income calculation is not really going to be applicable per se, because then at that point, all of this income is going to be detailed in the profit and loss report provided by the accountant. And then, as is customary from these profit and loss loans, it may require the last 2 to 3 months bank statements to corroborate the income that is being stated on the profit and loss. So I was talking about the Schedule E income calculator. So wanted to just take you through some of the steps like here, pretty easy, right? You got all your investment property addresses. Step one, they're asking us enter the number of months the property was in service. That's going to be in the tax return. And then section A1 is as enter total rents received. That's also going to be on the Schedule E. Again, this is for a seasoned rental, right? Is where you're going to be using that. And then total expenses, right? On your Schedule E is going to have the total of the expenses, and then we're going to add back the expenses that we're not considering. So again, we mentioned insurance. If the borrower is already escrowing for insurance in their monthly payment, then you would definitely add the insurance expense back. Here is the mortgage interest paid as an added back amount, right? And then the tax expense, we're talking about property tax here, not income tax. It would also be added back if it was already included in the monthly payment in a mortgage statement, in the monthly payment that they may be making on the current loan they have on that property. If they're not escrowing for insurance and taxes, then you simply would not add anything back. You would leave it alone, and those amounts would be taken into consideration in the total expenses. And again, here's your other expenses, HOA dues, here's our depreciation, which is always added back, or depletion, if it actually lists a category called depletion in the Schedule E. Now we're talking one-time extraordinary expense, casualty losses, right? Like a fire, this, that. Here's where we're talking about the roof replacement could be considered a one-time extraordinary expense. You'd have to really document that well, but that is a possibility. Then here is our adjusted rental income after the minuses and pluses. Adjusted rental income divided by the number of months the property was in service to have our total monthly income. Now it's really important. The borrower is going to have to be able to document very well when he put the property in service. I mean, it says it on the tax return, how many days it was in service, but they may ask for things like rent, proof of the receipt of that first rent payment deposit, a number of things that the underwriter can ask you for. So this is your Schedule E income calculator that you would do for each property that you have. And really importantly, now we're almost done here, but wanted to point, this is the part in the application where the rental income breakdown is put. This is where most people mess up, right? They don't. Most people may not even know that this area exists, right? It's a tab on part 3 or page 3 of the application in Encompass, and the tab says FEOM, right? So you click on that, and it opens up all of the investment properties or primary, all the properties on the schedule of real estate owned for the borrower, right? So let's assume here our first one here is our subject property, right? So notice here we have gross rental income. That's the gross rental income that you're going to take either from the Schedule E, right, that we spoke about, rent received, or if it's an unseasoned rental, from the lease, right? So gross rental income here. Now taxes, insurance, and expenses. Now that's where you would get the net amount. Once you do your income calculation here, you're going to have your total expenses, and then you have the expenses that you're netting out or adding back. So you would get those expenses, you would add them back so that you would have a net expense, right? The net expense is what will go here. So obviously taxes and insurance isn't going to go here if it's already being included in the monthly payment. and then also your other expenses that may still be applicable, they'll be here. And then percentage of rental, if he's 100% owner and you're using 100% of the income, that would be 100 and 100. However, if he's not 100% owner, maybe he owns a property 50-50, you're only going to give him 50% of the income. And likewise, if it's an unseasoned rental that you're only going to give him 75% of the income, then you would have 75% here on that section. So this section here is where all of your final numbers need to be put. So the gross rental income, the net expenses, percentage of rental, participation percent, and then you're going to have a net income or loss here, which should match what you came up with when you did your Schedule E income calculator. So this is very critical. And then remember also, this is for DTI loans only. This would never be applicable for a DSCR loan. So what are some best practices that we want to touch on here? Just to recap some of the important points. I just mentioned it. Income calculations are not applicable for DSCR loans as they do not use any debt to income calculations. For bank statement loans, we'll need to verify receipt of the last 3 months rental payments that also need to match the lease. Now be careful on bank statement loans that you're not double dipping the income, right? On the bank statement loan, you got to make sure you back out any lease payments out of the income so that then you can calculate your rental income in one stream and your bank statement self-employment income in another stream. For a purchase, always use the 1007 value unless there is an assigned lease. And for refinance, you're going to use 100% of the tax return gross rent, or 1007 is vacant for season rental. Do not use the gross lease amount if it's a seasoned rental. We've already discussed this. And also, last but not least, make sure to consider the proportionate share of ownership. And we've had that come up every now and then. But the borrower is not 100% owner. They may be splitting it or not on the tax returns. You'd have to really see what the tax returns show. And if it doesn't really take into consideration the fractionality of their ownership, you got to make sure that you take it into consideration, because the underwriters will review the tax returns to see who owns what. They will review if it's some type of a loan, property owned in an LLC or something like that. They're going to ask for a copy of the operating agreement. They're going to see who's the owners, and if our borrower is not 100% owner, they're not going to give them 100% of the income. So don't be caught by surprise on that one. So again, make sure that you review all of the theory up front, all the different points that you have to take into consideration, because the actual math is very basic, right? The actual math is for the full doc, looking at the Schedule E on the tax return, transferring the information to the Schedule E income calculator, but you got to make sure you transfer the correct numbers, and that's only going to be possible if you understand the topics that we covered in the beginning of this presentation.
I think that's a great point, Jose. It's more about just knowing the numbers to put in the boxes, right? Putting the numbers in the boxes is relatively simple.
Yeah, I mean, a lot of times these income calculators even give you line numbers to go to and everything, right? But if you don't understand the theory of why you're putting it in there, you may just grab something from a line because it's on there, and you didn't adjust it accordingly.
Absolutely. All right. I don't see any questions. Anything to add, Nick, or are you good over there? I don't see any questions coming in. No? All right. Okay, well, let's go ahead and wrap it up then. Remember, we do this every Tuesday, Wednesday, and now Thursdays. We are doing them as well at 7 p.m. Eastern time, so make sure to tune in. So we'll be back tomorrow with a new training at 7 p.m. Eastern time. We appreciate everybody tuning in. We'll see you tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a good night, everyone.